While big oil saw plunging profits this past quarter on slumping energy prices, they are set to see some relief as gasoline prices hit an 8-month high with the national average at $3.73 a gallon. Oil prices up about $10 a barrel just in the last month. And joining us right now to talk about that is Tom Kloza, the global head of energy analysis at OPIS. And Tom, what's driving these higher prices?
Higher crude oil. Crude oil prices are up about 13 or 14% since June 30th. But also, you've got a lot of refineries that are coughing and wheezing. They're not really geared to run with 10 or 15 days of 100-degree temperatures in a row. So that's part of it. And gas prices are up about 30 cents. Diesel prices are up about 30 cents wholesale. So it's easy to predict that we're going to go considerably higher from here.
What about the demand picture, just in terms of the driving season being here? Pretty strong economy, at least here in the United States.
Yeah, Becky, it's not gasoline demand in the United States. Gasoline demand here is probably about 500,000 barrels a day, or about 5 or 10% lower than it was from 2016 to 19. You're seeing much more efficient vehicles, and you're seeing some intrusion by electric vehicles. But we are exporting close to 1 million barrels a day of gasoline to Latin America. And as long as Latin American populations grow, our Gulf Coast refineries are going to be the suppliers to that region.
China's economy has seen some weakness. What impact has that had on global oil energy prices?
China is kind of the dog that didn't bark in all of this. I think the Chinese reopening trade has been largely very, very disappointing. Now, they were importing more crude oil in the last month or so, but most of the scholarship indicates that they were importing more crude oil, not because they needed it, because they wanted to build strategic inventories. So I think they're not going to be necessarily the driver for a lot of strong prices in the second half of the year. I think it comes from the Saudi cuts of 1 million barrels a day, which are for July and August. And now the market seems to believe that they'll extend that into September.
Russian exports have dropped too, haven't they?
They have, but you can't believe what you hear from Russia, clearly. So they have dropped, but it's not clear whether they're dropping because buyers are refusing to take it or the sanctions are working. But yeah, I mean, that's one of the reasons why in this quarter, I think most of the people that follow oil believe that supply is going to be about 2 million barrels a day short of demand. So we're going to be depleting inventories within the quarter. It changes in the wintertime, perhaps, but for this quarter, supply is not enough to take care of demand.
Tom, if you would have asked most people in the sector at the beginning of the year, I don't think they would have said they anticipated oil prices would be as low as they have been, $75, $76. Was that just OPEC kind of throwing everybody off by cutting supply?
Yeah, I think OPEC was a big reason. And again, the Chinese reopening never lived up to the hoopla. And it was probably disingenuous to think they were going to be driving commodity prices higher across the gamut. So I think that's the thing. But I would stress one thing. Last year was an epic year for profits in the oil business. This year is pretty good. It's just not up to the par of, the numbers that were off the charts in 2022.
And if you had to make a guess, I know it's tricky to do, but WTI up or down from here?
I think WTI is stuck between about $70 and about $85, and that's the range. We don't like ranges. We like wild, dynamic prices, but I think that's probably where we'll be. You hear $100, it would probably take another OPEC cut of probably 1 million or 2 million barrels a day, or some sort of fights in the Mideast that would do that. And I don't think that's likely.
For consumers, just prices at the pump, is the expectation that there will be relief in a month or two as refineries? Look, it's not going to stay this hot for forever. The refiners are going to back to producing.
This is not the new normal. Right now, you're baking in probably a Category 3 hurricane, at least threatening Gulf of Mexico crude and Gulf of Mexico refining. And in August, prices tend to come down. And the recipe for gasoline changes in about a month. And there's a lot of cheap hydrocarbons that you can put into the recipe. So we'll see lower prices in the last 100 days of the year.
What about EV adoption, electric vehicles? I mean, at this point, we may be producing more than people actually want, but you've got some pretty lofty goals. Some companies like GM that have said they're going to turn their entire fleet electric by the end of this decade.
And you know,
what happens to prices as EV adoption picks up, or do you think that these expectations are a little too rosy?
No, I think they're probably too rosy, but I think certainly we've seen the highest gasoline demand in the United States that we'll see in our lifetime. You know, I mean, thankfully for refiners, Latin America is sucking up the additional gasoline. The question with EVs is if you sell 1 million EVs, how much gasoline does it diminish? And, you know, that's an interesting hypothetical because for a lot of people, the EV is the second vehicle, which they just use to sort of tool around town. So it's going to have an impact. And I think the second half of this decade in the United States, we'll use a lot less gasoline. But refiners are okay because Latin America is growing. They don't have the EV adoption. They don't have the infrastructure. And we are the suppliers to the world.